Today I have with me Michael O'Brien at Fundsmith Emerging Equities Trust. But first of all, can you outline your investment approach to running an emerging market equity strategy? And what key attributes do you look for in a company? And could you give us a couple of examples of stocks that best exemplify your approach?
I'd be delighted to. Our overarching investment objective is to benefit from the growth of the consuming class in emerging markets. This is not just about increasing absolute population numbers, but also about those populations becoming richer, which both spurs consumption and ultimately encourages premiumization and changing tastes and consumption habits. We follow the same philosophy as a highly successful Fundsmith equity fund, which is simply buy good companies, don't overpay, and do nothing, which simply put means hold them for the long term. To us, there's four attributes of a good company. First, high cash returns on operating capital. Second, the ability to fund their own growth by the reinvestment of these cash flows at high rates of return. Third, we look for businesses with a high degree of predictability, ideally generating their revenues from many everyday small ticket repeat transactions. And fourth, we look for businesses which have high barriers to entry to protect their returns against competition, whether it be through brand, market structure, distribution, logistics, regulation, or scale. In terms of examples, currently the largest holding in the fund is Mercado Libre. Mercado Libre is the largest online retailer and payments business in Latin America and operates in 18 countries. PayPal is a strategic investor in the group. The business has seen compound revenue growth of 37% over the last 5 years. Despite this, the e-commerce penetration rates are low in the region. Around 5% of overall retail sales in both Mexico and Brazil are carried out online, which compares to about 15% in the US and around 23% in China. Mercado Libre's e-commerce operations give it a substantial cash flow through negative working capital, which it reallocates into other parts of the business. Almost all of the successful e-commerce businesses globally can allocate the cash generated from their e-commerce businesses into other profitable and high return growth opportunities to make sure the compounding we are looking for happens. For Mercado Libre, that is primarily its payments business, which has developed from first just serving captive purchasers into other digital sellers and subsequently bricks and mortar stores. The second example I would cite is Nestlé India, which is another one of our largest holdings and India's largest standalone food company. Although we have reduced the number of listed multinational FMCG companies the fund owns over the last couple of years, Nestlé India is a strong business which is locally managed and has grown sales at a compound rate of around 12% since the turn of the century. It has market leadership in over 80% of the categories in its portfolio, and for example, is a market leader in noodles, infant formula, infant cereals, and instant coffee in India, with 50% plus shares in all of these segments. As India develops, the growth of categories in health and nutrition will follow. India also has over 200 million e-commerce users and around 40 million new ones are added per annum. The growth of e-commerce channels presents a major opportunity for not just this business, but most of the companies we own in our portfolio.
Michael, what's the structure of the team at FEET and who makes the big decisions?
As you'd hopefully expect from us chaps at Fundsmith, it's a relatively straightforward structure. I'm a portfolio manager, while Sandeep Patodia is the assistant portfolio manager. I make the day-to-day decisions. In effect, I pull the trigger. We have 4 analysts in total, all of whom have been there since FEET's launch, and each of which have responsibility for a defined geographical area. Terry, of course, is the group's CIO and clearly collaborates closely with the FEET team. He is consulted on any outright sale or new purchase for the fund.
How do you identify and monitor potential investments? I mean, do you have people on the ground or do you use external local research that might help with your decisions? And what's your level of engagement with companies?
I'll start off in terms of how we identify companies. When we set up the fund several years ago, we initially identified over 200 companies which form the basis for our investable universe. So as well as having a portfolio, which is currently off the top of my head 38 stocks, we also have an IU, which is a pool of companies we can invest in. This is around 80 companies, and we continue to refresh it all of the time, ideally finding businesses which fit our criteria through a wide range of screening processes and removing those businesses where we think ultimately they will never reach the quality criteria we are looking for. In terms of research, the four of us do pretty much all of our own research. All meaningful research is carried out in-house. We have little faith in or use for broker research. In terms of spread, our investable universe, as you can tell, is quite limited. And given this and the fact that there are many sectors we simply won't ever invest in, we don't have to spread our resources thinly at all. In terms of corporate engagement, yes, we do travel. Typically, I would be out on the road 4 or 6 weeks a year. We have a high level of ongoing engagement with the companies we own, whether it be through meetings, visits, or calls. Video call access now currently, of course, is the way most of these things are being doing. Access with companies at the moment is great. And I think, if anything, the current environment is opening access with those companies which may have been slightly reluctant to speak to or engage with investors in the past to be more open.
Okay, well, look, corporate governance, local practices and reporting standards, they're often considered as major challenges for investors in emerging markets particularly. Do you agree?
Yes, absolutely. We're well aware of this ahead of the launch, and it's always an area we always look at. We try and follow a half-empty glass approach to this. If we're ever unsure about governance or reporting standards, we simply refuse to invest. It's probably actually worth touching on some of the areas in governance we look at, as it gives investors a flavour for what can happen in some markets where controls are less stringent than in the UK or other developed markets. We would typically look at board structure and control, whether there are differential voting rights, the ownership structure of the subsidiaries, minority rights protections, management incentivization, and the track record of management. As you can guess, over 6.5 years of looking at companies for the fund, it's amazing some of the things we found.
Look, I mean, we see a growing trend towards sustainability in developed markets. So have you got any ESG considerations? Is this approach even applicable in emerging market equities?
I think potentially in EM equities it is. As a house, we don't dogmatically follow ESG approaches, but we actually probably get a very good ESG outcome, because largely our approach means that we're investing in businesses which have a strong ESG credential. Why? First, there are a lot of sectors we simply won't invest in, whether it be oil and gas, mining, heavy industrials and cement, all of which are not clearly the most environmentally friendly businesses out there. And I think second, most of the businesses we own would clearly have a brand element to them, and clearly they're stewards of their brands. If they were to do anything which destroyed their ESG credentials or acted against best practice in the field, it would tarnish those businesses and the value accruing for shareholders.
Okay, Michael, look, thanks ever so much for answering our questions today. Thank you.
Thank you.